Now I'm here to talk about compounders and compounding equities and how we at Solaris pick compounders to put into yours and our portfolios, and what are the warning signs that you need to look out for companies that once were compounders but maybe fallen angels and won't be compounding so more. So I'm going to kick it off with a famous quote. Compounding interest is the eighth wonder of the world. He who understands it earns it, and he who doesn't pays it. Now, there's a number of other famous quotes out there about compounding. One is from one of my favourite investors, Benjamin Graham, who says that it is one of the best mathematical discoveries in all of history. And it's often referred to in the finance industry as the only free lunch on offer. So let's have a look at how powerful investing in compounding equities can be. We picked a portfolio of the 7 high-quality compounders on the ASX 200. Now, over the last 10 years, the total return in the ASX 200 has been a very credible 125%. What do you think the return of an equal weighted portfolio of those stocks has been over the last 10 years? An incredible 933%. Now, I think what's really important about this slide is that only 2 of those stocks are in that sexy, high-octane technology area. We've got a building products business there, a retailer, JB Hi-Fi, Cochlear, healthcare company. So you don't have to go to that really expensive end of the market to find these really quality equities that can compound their earnings year after year. And that's what we're after when we talk about compounding in equities, that consistent earnings growth. Let's have a look at Solaris, about the important criteria of compounders that we look for when we're investing in this sector of the market. The first element is the most critical, and every compounder has to have a high return on invested capital. Now, what do we mean by that? What is the return that management are going to generate from putting $1 into the business today? Investment into the business, not OPEX. And what we want to see is a really high return on investment capital, well above the company's weighted average cost of capital, which is typically around 9 to 10%. Now, we think that company management teams and boards investing organically through investment in their own business is the best way that they can deliver value for shareholders. The other thing we like is that when you're investing a lot in your own business today at high rates of return, that really improves your earnings growth outlook in periods to come. As long as the base business is performing well, you're underwriting that earnings growth going forward through that high return on capital you're investing today. We want to see companies with high pricing power. We're talking about companies like Seek and REA, dominant positions in their industry that can pull the pricing lever and demand does not dissipate. There's no demand elasticity there. That's what we'd like to see. I think interesting was that a lot of companies had pricing power during COVID, even companies with homogenous products, building products and all sorts of different products. But today we're seeing a more normalisation on that pricing power, and only companies with true competitive advantage are able to pull that lever given the current pressure that the consumer's under. We want to see companies be able to thrive in all economic cycles. Everyone does well when the economy is booming, but what does the outlook look like when the economy is starting to slow a bit and things are getting a little bit difficult, such as today's economy? Well, these compounders, they can take market share from a weaker competitor base, and they can also increase prices to support their earnings growth. We want to see companies with a really long run rate of growth, and often we see companies do really well in the Aussie market, and then they venture offshore. They go to Europe, they go to the US, they go to Asia, and things haven't quite worked out as well as here. Success in Australia does not guarantee success when companies enter offshore markets. And we want to really assess what that offshore growth runway looks like. On the competitive advantage, what we're really looking for here is barriers to entry. We want to see barriers to entry remain high, because when barriers to entry fall, that is when new competitors come in and your return gets competed away back to your weighted average cost of capital. And we want to see innovation stay high. We want to see high research and development spend. And when that starts to fall, we're starting to ask questions. Are management not seeing the opportunities to invest in their own business once we're? What are they seeing that we are not? So let's have a look at an example. Aristocrat Leisure. This company was founded by Leonard Ainsworth in 1953. It is a leading developer of software that's used on the gaming floor, and now they're pivoting to online gaming, slot machines. Now have a look at those blue bars. That is their return on capital over the last 15 years. Those blue bars have averaged 18%, well above their weighted average cost of capital, around 9 to 10%. They invest 30% of their revenue each year back into the business. Now let's have a look at what that return, that investment that they've spent has done for earnings growth over that period. Earnings per share is up 690% over the last 10 years. And as we know, share prices follow earnings. The share price is up even more. They've even had a re-rate during that period. So they've had a strong history of returns on investment capital above WACC. They've had a fantastic growth run rate in the past, seen by that earnings growth, and the business is now pivoting to online gaming. And they can use that intellectual technology that they've been using on the casino floor to exercise that into the online gaming market, and they're doing that very well. The business has got great pricing power. So they used to sell slot machines per unit. They've recently pivoted to a leasing model. Now what that leasing model has enabled them to do is increase their recurring revenue in out of years. It's now 72% of their whole revenue. Now what does the market do? They've got earnings and revenue certainty in outer years, so they're prepared to put a higher multiple given the certainty of that revenue and earnings flowing through. This company's cycle resistant. Despite what you may think, casinos are technically discretionary spend, but history shows us they're not. Casinos do very well in recessions. Star mightn't be doing that well at the moment, but the casinos in the US at the moment are going gangbusters. The other way this company's cycle resistant, they've currently just completed a $1.8 billion buyback, and they recently announced last month at their result another $750 million. They've got great competitive advantage through the strong intellectual property they built through all that investment, and they've got great relationships with regulators, casinos, and now their online customers. This is a company we hold in all three of our strategies, our core fund, our long-short fund, and even our income fund, which has a dual mandate for capital growth and income. Now, it's not all rainbows and lollipops out there, and there's a number of warning signs that you and us as investors need to look out for fallen angels. Companies don't stay compounders forever is what we're finding out. And what are the warning signs that we have to look out for as investors to pick up these fallen angels early on? The first is reducing return on capital investment. Now look, when a management team's investing in their business, they're not going to come to us as investors and say, hey, we've got this great investment opportunity, but the WACC's returns are a bit below WACC. So that's up to us as portfolio managers, analysts, to do the work and to understand what the sustainable returns will be on that capital investment into the business. The other warning sign is large M&A. We really get worried when companies are buying from private equity, when they take on goodwill in M&A transactions, and when they venture offshore, and when they venture into new products. They're all big warning signs for us. And lastly, we all know about Kodak camera. What's happened there? They failed to invest in growth in the business. They failed to pivot from print to online. And as we know, they lost their competitive advantage and the product's now irrelevant. So I want to walk you through a case study of a fallen angel. Now, Domino's IPO'd onto the market in 2005 under CEO Don Mage. It had amazing success early on. In those early years there, they had fantastic return on invested capital. They also had same-store sales growth that's been 10 and 15%. They outgrew Australia pretty quickly, so what did they do? They went offshore, aggressive overseas expansion. In 2013, they went to Japan, and in 2015, they went to France. And we all know the French are very picky eaters. And that execution in the offshore markets has really underwhelmed. The other thing that we've seen in more recent years is fading competitive advantage. Back in the early years, Domino's pitched themselves a technology stock. I used to love watching on the app where my pizza was and what time it was going to be delivered. Now we have a look today, we've got Uber Eats, we've got Deliveroo, there's all number of these delivery apps that have eroded the Domino's competitive advantage. As we've seen there, return on invested capital has now fallen below their weighted average cost of capital. We've been short this stock a number of times over the years in our long-short fund. Let's have a look at a second case study of a fallen angel, CSL. Most people in the room will be familiar with CSL. They were one of Australia's hallmark compounding equities, a long track record of earnings growth. They're a leading provider of vaccines and medicines globally. Now, back in 2021, they announced an acquisition of Vifor Pharma. Vifor Pharma's a European-based business that specialises in iron deficiency. And so far, that acquisition has underwhelmed the market. And let's have a look at some of the reasons why. The first reason was Vifor Pharma had a return on invested capital at the time of the acquisition of 6%. That was against CSL's return on invested capital of 20%. So it's a far lower profitability company, lower margins and lower returning. Now you blend these two businesses together today and the return on invested capital is around 12%. So they've taken a real hit. We've also seen increased competition in that Vifor Pharma business. They've been attacked by generics. Generics have come in and eroded their competitive advantage and pricing power. And so the result of that has been a flatlined earning per share now of CSL for the last 4 years after a long history of growth. And management's been distracted while they're blending these two businesses together. So as you can see, investing in compounding businesses can lead to a lot of alpha generation. And at Solaris, we also view ourselves as investing in a compounder. We've got a long-term track record of investment success. We've outperformed in 18 of the last 24 years. We've got 3 products: our core product, our long short, and our income product. And the last slide I'd leave you with is our most recent performance. Thank you.